Investors face a few dilemmas at the moment. The first has to do with the rand and whether now may be a good time to take more money offshore. But if you choose to do so and hold your investment in cash or fixed income, your investment returns are likely to be worryingly low. Putting more money in the local market has risks too, especially if you consider warnings that the JSE is expensive. Well, Lee Cairns gives his views on this dilemma. He's a partner at Citadel Wealth Advisory Services. Welcome, Lee.
Hi, Erika.
So lots to talk about, and I think lots of hand-holding, I'd imagine, with your clients. And the rand's always a dilemma because we have this lemming sort of behavior. When the rand's weak, we want to go offshore, and we're sort of heading that way again.
Sure. Those of us that have been around sort of a while now will know 98, 2002, 2008 and another blip now. We always have that tendency to do the knee-jerk, which is normally the wrong thing in hindsight, exactly when the nervousness is there. And for political reasons, all sorts of other things, there's sort of some doubt as to where we're going over the next 5 to 10 years. And the potential is to do the wrong thing now again, with the rand seemingly a bit oversold. So definitely the last 3 months with Marikana and the like has got people sort of behaving a little bit uncomfortably, and the potential is that you can have a few mistakes when you're forced into making a decision during that time. So yeah, we're definitely there at the moment, unfortunately.
Lee, it's almost like the rand acts as a barometer to the health of the South African economy, and especially with many South Africans, when the rand blows out, it's almost like they become permanently pessimistic about the prospects of the country, and they forget everything that's happened in the last 18 years. You've got a very sophisticated client base. Is that the similar sort of emotion that comes into play when we see the rand go from 8 Rand 20 to 8 Rand 90 in the space of a couple of days? Is that really part of your role as a financial advisor, is to just calm people down, remind them that it's a long-term game and the country's not going to go over the abyss immediately? Yeah,
definitely. I mean, there's more sophisticated clients, I think, that have seen South Africa through what it's been through over the last 15 years, if you use that as a time horizon, are starting to realize that we behave like a lot of other emerging markets with some other sort of political attachments there, but that there's actually an opportunity to make some money if you behave counter-cyclically to what everyone else is. Unfortunately, though, the majority of the market is doing exactly what you've just described, and us as advisors, as a relationship with clients, is to try and negate people making mistakes because of their sentiment around what's going on, and therefore I have to make a decision now, even though it doesn't feel like the right thing, but I need to just make a decision on it, and I'll deal with the consequences later, which normally are consequences that have had a negative impact when we look back at those years I was mentioning just now, 98, 2002, 2008. So my job's a difficult one. My job's one, driving around to see clients, trying to get them to cool it down a little bit on how much sort of emotion they're feeling regarding what they're seeing on the news, etc. So it's normally trying to second guess people to say, well, let's have a talk about why you jumping to those conclusions as to why you need to do something now.
And there's the age-old question of how much money you should have offshore, and I know it depends on a whole bunch of ththings, whether you're going to retire in South Africa and your risk appetite, etc. So what do you suggest? Is there a recipe?
Yeah, look, the exact recipe is probably different per person. So I think if you've got an eye on maybe ever living somewhere else, then it'd have some effect on the percentage. At the moment, we've got about a 55% offshore, 45% locally. But even that money that we invest offshore, we hedge out the currency because most of our clients will be retiring in rands, and because of the volatility on the rand that we can't predict as to when those people might draw down on that offshore investment. We'd rather just hedge it out, and then we have the predictability of the rand.
So you're going offshore for diversification and to those pockets where you're seeing better returns?
Yes. So Citadel spends a lot of time on scenario planning, having a look the world over as to where we see the opportunities and what's likely to play out from here. Once you've done that, and we like certain asset classes, we don't like to be restricted to, well, because we're South African, let's look, if we want to be overweight equities, South African equities, let's have a look at the globe, let's have a look at where we are priced relative to other BRICS, if we like emerging markets, how the developed market is looking at the moment, and then place accordingly. But sometimes we'll need to hedge out that currency, and we're probably in that place at the moment, to be honest. We don't want to not invest offshore because of where the rand is, so we're looking to invest offshore and probably hedge out some of that currency if we're doing new money investments at the moment for clients.
At this point, Lee, are South Africans quite comfortable investing offshore? What's their sort of appetite for, I don't know, let's start with the developed world, going into the places like the UK and European and US equity markets. Is that something they're sort of comfortable with? And then if you pan a little bit wider into emerging markets, is there a difference in the sort of response you get from your clients when you talk about perhaps diversifying out into some of these markets?
Yeah, 100%. I think The risks that have shown themselves since 2008 in the American, Europe and UK, everyone sort of assumes that hasn't yet been priced in, so therefore I can't go anywhere near those markets because that's where the biggest global risks exist. So certainly I think clients have in the past probably been more risk averse to those than other BRICS. Then if you look at Brazil, China, those type of things, I think if you're going to diversify outside of South Africa, typical South African would say, well, that's where I've got to be because that's where the GDP growth is likely to be the best. But what people don't realize is that the growth in your investments and the underlying equities often is very out of kilter to actual GDP expectations of those places. So, you know, we've seen big disparities in returns from the underlying equities of geographies that we've been held in to the actual GDP. And I think that's sort of one thing that South Africans and maybe less sophisticated people around the world still battle to understand. You know, where there's potentially more bad news, but the risks seem to have been subsiding as to what the potential is of a double-dip recession, Europe, for instance. Potentially there's some of the best opportunities if you look at the multinationals that are there, who are getting a lot of their revenue and their upside from the emerging markets anyway. So, yeah, there's still a lot of that, yeah, Warren.
It seems to be counterintuitive, doesn't it, that you go to places like Europe and America at this point to find great investments, and places like China and perhaps India, which seem to be the economic engines of the world at this point, have stock markets that haven't performed very well. But if we bring the debate back home and we say to you, we've got money, I've inherited money, and I'm considering what to do with it at this point, is there still value in the local equity market? And should we still be looking at our equity market despite what the fund managers say on Investment 360?
Yeah, there's definitely still opportunity in the JSE. So I think the assumption is that at 37,000, wherever we are today, that it's too expensive. But there's huge disparities between those that are driving it to the expensive. And you had a guest on earlier, Paul, who was initially talking exactly to what I was going to be talking to, and then he suddenly jumped into the Mr. Price ShopRite space, and I suddenly realized, we've got very different outlooks there. Certainly on the resources, and we are holders of Sasol, we think there's huge opportunities there, especially when a Sasol pays a dividend of 5% recently. So the disparity on those P's of between 7 and 9 of BHP, Anglo, you may or may not like it for whatever reason. Goldfields has got a recent issue, but I think they'll be fine. And Sasol, as opposed to the ShopRite and Mr. Prices, if we look at the retail specifically at P's of 25 and north, I think you'll find that most of what's driving those share prices are actually the foreigners. And if you think about when we invest into the globe, we don't really understand as much about the companies that we invest into as us as South Africans sitting right here. So my understanding of what Mr. Price is doing, priced at the level that it is, I don't get it. And when the foreigners maybe get the same sort of understanding that we're getting at the moment, I think there's a potential risk for quite a significant come off of those particular shares.
So where is the local value then?
The local value is definitely in the resources. A company like Steinhoff is quite cheap as well at the moment. African Bank is not Citadel's liking as an example, but it has become quite cheap from a price to earnings point of view just lately because of where it's come off this year. So the disparity in those to where they are price to earnings, and then even good companies like Naspers and Aspers, and I like Naspers again, but the problem is when good South African companies go outside of South Africa, for whatever reason, as we've seen Woolies and Pick n Pay and even an Investec, fantastic company, they get burnt. They come back with their tails between their legs. There's a good chance that one or two of those four that I've just mentioned may well get the South Americas and Africa right. What I can tell you now is not all four are going to get it right, and you're paying a premium for all four of them getting right at the moment. So for me, I'm nervous a little bit in that space, and that's why I think go to where, often investments just you get back to, even if you're not from an investment background, just what makes sense. I've got people telling me China's going to slow down to 0, well, that just doesn't make sense to me. I've got a client at the moment who's in Indonesia who's got a population of 200 million who want to develop and industrialize themselves. Well, if they're going to, they need the resources, and the resources are a finite, there's a finite supply. So therefore, while the sentiment is negative at the moment, if your horizon is longer than 3 years, that must be the place where you're happy to put your money and just sort of sit and wait for it to come, because believe me, it's coming.
Right. Getting some of these decisions made, you obviously use external fund managers. We were talking before we came on air about the active versus passive debate, and we mentioned it with the previous guest. Where does the use of ETFs and passive strategies come into your thinking as a wealth manager for some of your clients?
Look, the conversation, especially in a low yield environment where we've been and where we still may go, is definitely a question that people come and ask, why should I be using an advisor who uses active managers, because the expense and the layering adds up, so why don't I negate that and just buy the ETF? I think if you look at the average active manager, they will underperform, and therefore if you don't know how to actually due diligence a manager who's got a philosophy, perhaps a track record that's going to outperform, the chances are that you are going to be worse off by not just buying the ETF. But if you find the right managers, and the trick is to find who's the next big card, who's not already 13 billion, who's got the philosophy and the understanding to take advantage for the next 10 years. Right. There's no doubt that you will significantly outperform the market by finding those managers. The trick is how. And we spend a huge amount of our time at Citadel traveling the world, meeting our fund managers abroad face to face to make sure that those are the people that we think. And we're not scared to go to a fund that's only $200 million in size. Potentially that could be the next $10 billion fund, because we know once you reach the 10 billion that a 12 billion that Orbis is, it's quite difficult then to outperform the index at that level.